I have financed property and now I'm considering whether to put some extra money into a special repayment or not, and maybe invest the money elsewhere. What actually makes sense now? The answer is here today in this episode. Here's the scenario. You currently have a bit more money available than you originally expected. And now you're faced with a decision. You could use the money for a special repayment to take advantage of your mortgage, to pay less interest in the long run, or you could invest the money in the stock market where it could potentially grow. So what's actually better? That's exactly the question we're tackling in today's episode. If you want to find out the answer, you should definitely stick around. And with that, a warm welcome to the new podcast From Saver to Investment Property. My name is Fabian Schuster and my vision. It's about narrowing the gap between the rich and the poor in the German-speaking world a bit. How can we make this happen? The best way is through meaningful financial decisions. Yes, and I can make those decisions because when I'm not sitting here in front of the microphone, I've been working as a managing director and still as a consultant in our company, Capri Consult, for over 10 years for exactly this reason. And together, we have independently supported over 500 people, helping you transition from a saver to an investment property owner. And so, in collaboration with our clients, we were able to not only build high 7 or even 8-figure assets, but also to maintain them. And we want to share this experiential knowledge completely free of charge with you through our podcast as well as our YouTube channel. So, back to the topic. It's about the tricky question of whether to pay off debt and the loan faster or to invest the money and let it grow. Which is more profitable? Both options have arguments in their favor. So let's take a closer look at the options and the consequences that come with them. And above all, there will also be a calculation example today. Anyone who has taken out a mortgage may have the long-term goal of becoming debt-free. With a special repayment, you can shorten this somewhat longer path. Of course, you can also shorten it significantly. Most banks offer the option in the financing contracts to make a special repayment once a year outside of the regular installments. Paying off 5% of the remaining debt through a special repayment is free of charge. This way, you naturally get a little closer to your goal of being debt-free with each step. And of course, you also save on interest because the lower the remaining debt, the lower the interest as well. This is because it's always calculated based on the current remaining debt amount at the percentage interest rate you've agreed upon with the bank you have applied. So the advantages are pretty clear here, right? But what about option 2? What if you invest your extra free capital in the stock market instead of giving it to the bank? That only makes sense if you achieve higher returns with it than the interest you pay on the loan. Investments have the potential to yield high returns, especially when you're working with stocks, funds, or other investment forms that have high return potential. It also offers the option to invest. The big advantage is that liquidity is maintained. So if you're working with open investments, you can still access the money even during unpredictable times when they come your way. That's not the case with the special repayment in your financing. Once the money is tied up in the financing, it's stuck there. And it can usually only be released through a termination of the loan where, of course, liquidity has to be ensured, or it is only released again when you sell the property. However, it's important to keep in mind that the investments you make in the stock market, for example, can also come with risks. So there is a possibility that you could also lose money, especially if you invest in particularly volatile markets and high-risk assets. Therefore, if you choose this option, you should take a balanced approach that can potentially exceed the interest on the loan with its possible returns, but still doesn't pose too high a risk for you. So what doesn't work well? The savings account, because the interest rates minus inflation are just too low. That's only suitable as a cushion for unexpected expenses. The fixed-term deposit isn't suitable either. It's similar to a savings account, except that you can't access it for a defined period that you agreed upon with the fixed-term deposit provider. Bitcoin, individual stocks, and other speculative transactions have no place in retirement planning anyway. This is more for play money, so if it really doesn't hurt if you gamble the money away. But if you want to plan for that money to be available later to pay off your property, then you should consider something else. That wasn't very specific, so let's take a look at a theoretical calculation example to compare the two options. Let's assume a mortgage loan of 300,000 euros with an interest rate of 1%. Yes, that was still the case recently. It doesn't matter, you can do that with all the other calculations as well. And an initial repayment of 3.5% over a term of 20 years. The property is valued at 400,000 euros. And for the calculation example, let's assume you can make an additional payment of 3,000 euros each year as a special repayment. After 20 years, the loan is paid off except for a small remaining amount of 1,500 euros. So your total assets amount to 398,500 euros if there is no further appreciation of the property. Let's subtract the remaining debt. 1,500 euros. Let's talk about those 398,500 euros. In option 2, there are no special repayments. Instead, you invest 250 euros monthly, which adds up to 3,000 euros over the year, instead of putting that into the special repayment. You invest it in an ETF savings plan, that yields, let's say, an average return of 5% per year because you've done well. For a long-term investment, it is not necessarily unrealistic. After 20 years, you will have not paid off 67,000 euros of the mortgage loan, but your capital in the ETF account will be at 101,800 euros. When you offset all of that against each other, your total assets would then be at 434,800 euros, which is 36,300 euros more than the value of option 1. So according to this calculation example, it would definitely make sense to invest the additional financed funds first and use the returns to pay off the remaining loan. But here, now comes a bonus tip. On one hand, you need to consider that if you have a rental property, the interest can also be deducted for tax purposes. This means that interest rates only hurt half as much. So it's not so bad to pay interest, because if you have rental income on the one hand, you also need some expenses in addition to the depreciation. And if you already own a home that only you live in, then it's especially important to come up with smart strategies, because with a primary residence, it's naturally a tax matter. It's structured in such a way that you have very, very few options. Making any tax benefits and optimizations is not possible compared to an investment property, which has all sorts of freedoms. But it can be a smart financial strategy to acquire an investment property in addition to your primary residence. How? Property? On the way to the property? Yes, exactly, that's the system. The property that runs alongside should serve as a constant source of income through rental income. And ideally, it also gains a bit in value, or maybe it doesn't. That's not a problem at all. It can also work without value appreciation. If you sell it after holding it for 10 years, according to current tax laws, the speculation period has expired and you can sell the property tax-free. This means that the profits you could make from this appreciation won't be subject to taxes. Sell. That means the profits you could make from this appreciation won't be taxed. And now comes the really clever part. So you now take this tax-free profit from the sale of the investment property and using it to pay off your home loan. That means with the investment property, it's not a problem at all. The point of the matter is that you pay off the loan. The investment property usually benefits from the differential business. What does differential business mean? For example, if you purchased a property, I don't know, for 200,000 euros, a nice little condominium, you just let it run for 15 years and then maybe half of it is paid off. That means let's assume you financed 100% of the purchase price of 200,000 and have paid it down to 100,000 euros. Then, if you were to sell the property, it would be for 200,000 again. Euros. So without any appreciation, you have 100,000 euros. Euro free capital available, which you can then use to invest in your own home. And that's obviously the super mega trick, because with this, you can not only take advantage of the tax benefits of an investment property on your way to paying off your ownership, but also build wealth faster. And at the same time, you can quickly pay off your dream, your own home, your assets, which might be especially important for your retirement planning later on. Super combo move. So, In this way, you use the capital that you've built up through your investments to reduce your debts. Either, for example, through a savings plan or by using the property as an investment. It's the best of both worlds. You benefit from the advantages of home ownership, feeling stable and secure while building capital for later, or maybe something to pass on as an inheritance. And at the same time, you benefit from the advantages of real estate investments, such as income generation and tax-free capital gains. Or with the ETF savings plan, you have all the flexibility of your money when things change. And if you use these combinations, you will, of course, significantly improve your financial situation. As if you always put all the money you've already paid taxes into your own property. Then it's nice. If you've paid it off, but you still have to start building additional wealth and afterward. That can be much more effective and faster. It's absolutely important to note that the strategy requires careful planning and management, and it also comes with risks such as market volatility with ETFs or liquidity issues if you don't plan and execute the sale properly. Therefore, it's advisable to seek professional advice before you decide on such a strategy. It really has to fit. So if that sounds like something for you later on, then don't hesitate. Then you can reach out to us here through the contact form. That's exactly our daily business. We do that every day. We're trying to find the right ways to turn 1.02 euros into 2.03 euros into 3.04 euros, and so on. Depending on how much time you have, you should definitely find the right strategy for you and stick to it. And a good advisor will really kick you in the butt to make sure everything gets implemented just as you planned. So you don't burn money, but actually make more out of it. After all, you all worked hard for this, right? So, we can definitely develop such a strategy together. Just reach out through our contact form. I've linked it for you here. I personally review all inquiries. And if we're not nearby, I'm happy to recommend an advisor in your area. What you shouldn't forget is to subscribe to this channel, because next week there will be another exciting new episode that you shouldn't miss. So, until then, see you soon, your Fabian.